All right, so let's start out with some formation patterns. These are what most people rely on. This is the way most people were taught. I know I was when I first started out. And these are the most basic and the most popular formation patterns that people use when trading the Forex markets. First one is an ascending triangle. This is a bullish pattern. And the premise is basically where you have this kind of a triangle as we have here in the lower portion, where you make a higher high followed by a lower low, and then another high which pretty much matches the previous high, followed by a lower low. So you have this ascending triangle right here. And then when it breaks out of this resistance, that you have a really nice upward move. That's the goal behind the ascending triangle. Where in reverse form of that is the descending triangle. It's basically the same thing, you just turn it upside down. Okay? We have a low, followed by a lower high, followed by another low, which is just about the same as the previous low, followed by a lower high. And then once we break that support, that's when the move goes to the downside. That's the supposition that a descending triangle is. It's a very negative pattern. Or how about this pattern? This is an ascending wedge. As you can see here, we look like we have a wedge formed. And an ascending wedge, even though it may appear bullish because we've been going up, is actually very negative, because the premise is that once we break this wedge here, we close below, we should have a very nice move to the downside. Conversely, we have a descending wedge. All right? As you can see, once again, it looks like a wedge pointing to the downside. The school of thought behind this is once we break this to the upside, we have a very nice move to the upside. Okay? These are all very popular patterns here. These are all very popular and used a lot by Forex traders. And probably the most common and popular pattern used out by all traders is the head and shoulders. Okay? It's a very, very simple pattern, something that most people see right off the bat. And all it is you have some support right here, which is called the neckline, followed by a left shoulder, a higher high, which equals the head, and then a lower high, which equals the right shoulder. So you have this shoulder, head, shoulder point of view, and the common thinking behind this is once you break the neckline, the support, you'll go down much lower. And the same thing works upside down as well. Here's a perfect example of how that worked in the dollar-yen on a 4-hour chart recently. As we can see here, we have a 4-hour chart of the dollar-yen. Someone would look at this and go, hey, wait a minute. We have a nice head and shoulders here. We have a neckline, which is our support. We have the left shoulder, the very complicated head up here, the double top, and then we form the small right shoulder. So in actuality, this is a great sell signal. We should be selling right here. We close below, and this is a great area to get short. So what you would do following this pattern would simply sell, and then look what happens. Okay? Look familiar to anybody? Now, someone would say, well, maybe I jumped the gun. Maybe I was a little bit too early. I'll just kind of wait around. And so you wait and you say, well, hold on. Now, possibly I was a little bit too early. I think actually we have a far better head and shoulders pattern here. And this is the actual head and shoulders pattern that I was originally looking at and what I originally wanted to do. So after all, you should sell this and it should go down, right? So you sell and then look what happens. So this is very common. We see this because, we talked about this earlier. Why is this? Because these are very subjective. In other words, it's not cut and dry. Remember we stated we want something that is cut and dry. We want something that everyone will see the same thing and it'll be consistent. We don't want to get stopped out twice in a row here because it'll eventually come back to us and we'll have a very difficult time trying to regain our confidence and get back into a trade. Here's another example of that. Support and resistance. This is probably the most common way that Forex traders trade. Everyone that I talk to, all of my students and people that I mentor and in presentations, they love support and resistance when trading the Forex markets. And that's all well and good. That's fine because support and resistance is something that's followed by a lot. It's very good way to trade. As you can see here, here's an ascending trend line. And basically it's resistance followed by higher resistance up the way, followed by lower support. So here's a perfect example of the British pound on a daily chart where we just about mirror that same image of support and resistance. Here's our resistance, higher resistance. As long as we keep breaking through, we should be doing fine. And here's our support levels. So what one would naturally want to do is purchase around support and sell around resistance. So looking at this, we'd wait for the British pound to come down to the support level in order to buy. And as you can see, it didn't work. Well, if that didn't work, well, then we're going to use the support level. Okay? this is where we're going to actually buy. And as you can see, that didn't work either. So once again, the truth about these formation patterns is that they're great when they work, but when they don't work, they're miserable. They're very difficult to trade, and they're very tough to get a hold on. So when they work, they're great. When they don't, it's very tough. The reason is because they're too subjective. Remember, we want things that are cut and dry. We don't want things where someone can look and say, well, that's support, and someone else would say, well, no, that's resistance. We want things more cut and dry, and there are a great many educators that teach support and resistance, and there are a great many traders that make a great living off support and resistance. But it's very difficult to teach. It's something that you have to have inherent and be able to really focus and see on your own. I used to know tons of traders on the floor who had this kind of inherent type of chart where they could know exactly where support and resistance was. But see, it was subjective. They couldn't teach that. They just automatically knew. That's why we don't want to focus. As an educator, I can't teach something that someone feels. You have to stick to things that are more cut and dry. Now let's go on, talk about individual candlestick patterns. This is another thing that most people love to trade in the Forex markets. I think there are more candlestick pattern traders in the Forex markets than any other market. Well, let's look at the most modern patterns there are for candlesticks. You can see anything from a doji to haramis to engulfing patterns to piercing lines to evening stars. And these are all well and good. In fact, specialist trading incorporates a few candlestick patterns into our trading strategies. Here's the only difficulty with them. Once again, they are not as consistent as everyone thinks. As we can see here, we have a nice uptrend, and this is probably one of the most popular patterns around, which is the bullish engulfing pattern. So someone right here would say, that's a very positive pattern. Candlesticks, this is very positive. I'm going to go long. So you would simply buy, and then look what happens. Okay? Where's the consistency there? See, the trouble with candlestick patterns is that you have to trade them when they're in sync with the trend. In other words, if you've got a bullish pattern, the trend has to be bullish. And if you had a negative pattern, for them to work with consistency, the trend has to be negative. But most people use them the opposite way. And then also there are too many subjective and different ways in which to determine trend. So you see how all of this is getting far too overcomplicated. It's getting way too overcomplicated. Remember, we said we want to stick away from subjective things. We want to stick away from things that are overcomplicated. We want it to be consistent. Trading should be non-subjective, meaning that two people should see the same thing, not coming up with two different answers. It should be consistent. We didn't see any consistency there in those patterns. And it should be as simple as possible. Once again, it was getting far too complicated. So this is the trouble with common patterns that people have. Not to say that they do not work, but just that there's no consistency and they don't follow all of these three rules here.